And we are live. It's another episode of Blockrevision. It's 8:45 a.m. Each time. I'm very happy to invite you to another episode of the most important updates during this very hectic time on the markets. We are right after Fed's decision about interest rate hike, and it turned out to be, as expected, 75 basis points, but it's not over yet. We still have some path upwards in those hikes to be happen. So what does it mean for the market? What does it mean for stocks, indexes, commodities, and so on? Let's get into another episode of Blockrevision. Get it? So we are starting over with the first section for today, that is economy view, and we are right now jumping. Oh, let me get it through. Yeah. We are jumping to this section in order to have an approach of what has happened yesterday on FOMC meeting. We had rates risen to the level haven't been seen since over 10 years, and it's a very difficult situation for many of investors, as they haven't experienced anything like that before. They don't know how to react. They don't know how to manage their portfolios during the difficult time. To many of them, this gold investment, those commodities were the only one rescue from those inflation, and it turns out that this year is not favoring gold anymore. Right now, it maybe performs better than Bitcoin, but still not living in the doubts that it's not the inflation hedge at this time. With this very steep interest rate hike pathway that Fed has run us through, it shows that even commodities as silver and gold cannot really get us over this this fiscal hell. So we have to get inflation behind us. That's the narrative of Fed. So there is no painless way to do that. As Mr. Powell claims, the recent projections showing that the steeper rate path than officials laid out in June eventually came to fruition, and the most important for Fed right now, as we can see, is to restore price stability and having to come back those steepening curves that recently took off. And we need to do this by one of the means, that is this demand side entangled. When we just suppress the demand side, the inflation is supposed to get lower. It's not maybe the very high percentage of the demand side, but still something that influences those rates to some extent. So the softening labor market is something that we may notice during this difficult time, as that's the one of the nearly obvious factor that is supposed to suffer during this crystal clear Powell's policy of keeping raising rates sharply. So That was this one. And what has changed during this statement and why this is really serious? So instead of recent statements that led to a point that those economic gauges has softened, right now we are observing that the Fed is envisioning that those gauges are even getting better in some terms. They observe the point to modest growth in such sectors as spending and production. That's why they have found that there is even more necessity to keep their path of hiking interest rates by now. So during this June's and July's decisions, the market has played with the scenario of a possible pivot. Right now, they don't find it anywhere, and with this very strong inflation rates being noted, are we supposed to find that the biggest problems are still ahead? So prices that cannot be sustained led to a problems on the housing markets. Fed has also recently stated that we have probably were in the housing market where the prices couldn't be sustained. So this correction to get back those affordability of houses is something quite reasonable to happen, and in order to make this sector more achievable for young and also young people and also the middle class, that is in the point of view of Fed, something that need to get eventually lower. So this correction is kind of expectable, and also something that Fed is finding that soft landing would be difficult to achieve with these corrections, even to get further. So right now, I would say no one believes that either it's public or no Federal Reserve that the soft landing will eventually turn out to be. So job market, as I mentioned, already is cracking. United States full-time employment is showing its peak, and right now we can find that we may see a possible pivot, not maybe in a strong fashion, but still something that is expected to happen. So falling gasoline prices only add fuel to an economy already running hot with unemployment below 4%. So that's the one Fed's projection, and that's what finds that we cannot get lower than that. That's why those gauges should be more in a troublesome territory in the months to come. Yield curves inversions, and this chart shows that US recession risk rises as the number of inverted yield curves exceeds 50%. So right now we can find that that's the situation even worse than it was back in COVID-19. So the market expects the bigger headwinds than it was back in 2019. Spending like drunken sailors. That's observation regarding net deficit increase during Mr. President Biden started its presidency, and we can find that U.S. government is not stopping anywhere here, as there is no indication that spending will eventually slow. U.S. government still handling out COVID stimulus and wants it even more, with the expectations of this another wave coming this fall. So while federal outlays have fallen compared to last year as pandemic programs wound down, we can find that those problems are yet to persist, and that may reflect the US economy in the years to come, as this inflation really got out of control. So that's another thing to ponder. And Bank of England's also preparing for its QT. We are over another central bank lifting percentage point to 2.25. As expected, that was a hike of on the amount of 0.5, as UK is in a bigger trouble than it's in the US. That's why they cannot really hike that far away. And they also planning to sell more of the 895 billion pounds. So it means that the Bank of England is set to raise interest rates and start selling assets built up during a decade-long stimulus program. That was a historic tightening of monetary policy designed to clamp down on inflation, and that's the situation that we are reverting right now, and it will be met with a bigger economic obstacles to go through. So Bank of England eventually starting the quantitative tightening plan, and it means that it will only accelerate for the terms that may also have reverberations on the economy. In terms of market outlook, let's have a look at this one. I would like to, as I switched on market outlook, I'd like to have a look at what is happening on major indexes, and with this one we can observe that on S&P 500 on a row chart we are trying to making all our efforts on getting back to 3700s, low 3700s, as I mentioned back there. This candle, this reversal wasn't really convincing that we supposed to have a major run forward. We were about to just bring this bear rally up to 4300s, but we are still sticky to those levels of around 47th, 46th. That's why after this reaction we are still awaiting another drop and testing out this lows of of June. So that's the SPX, and let's have a look at right now. Let's have a look at another slide that will get us to Crypto Outlook, and on Crypto Outlook we have a Cardano hard fork that is about to been gone through this this day. So Cardano extends Bitcoin's accounting methodology to handle smart contracts eventually. So in terms of Cardano, there is a lot of I would say Fed rather than fundamentally speaking very devoted community. And during Cardano, whenever there is an upgrade upfront, many are claiming and that's the biggest event ever happened in the crypto community, but it's really not. Cardano is all about the FOMO, and I would say there is nothing better in Cardano than it's in a Polkadot, as I say, even if we consider that Polkadot has been just delivered 2-3 years ago, and Cardano about 5. So I would say Cardano doesn't develop that fast as it's supposed to, but it's all about the marketing, and even those smart contracts, scripted language being implemented, I don't find it will change the pace of development for much of the better. However, it's still kind of a psychologically boosted event in terms of possible price volatility. That's why you might have an eye for this. In terms of another, I would say, very controversial figure in crypto, or rather in traditional finance, but that reflect the crypto behaviors so much. Mr. Jamie Dimon, that is a CEO of JP Morgan, comments recently that cryptocurrency is a decentralized Ponzi schemes, and recently he have even called Bitcoin a fraud, that eventually said that he regretted that comment, and I would find that in around 1 or 2 years he would say that he regret that comment as well. So he's just spit out some stupid phrases without a cover, and afterwards he is making a backwardation of it, and I would say that's a part of the of this JP Morgan coin marketing, where you are trying to discredit the other tokens, other companies' tokens, and put in favor your own. You are definitely making a manipulative move. However, as a CEO of a JP Morgan bank, I would say it's still something that is allowed, and he wouldn't be prosecuted. So Mr. Dimon is probably once again trying to buy that Bitcoin lower and afterwards brag with that he could get it at the lower valuation. So and that's it from that part, and let's right now jump to market mover section, and we have, let's have a look at this week. on Thursday, we had Bank of England interest rate decision 2.25 being on the table, initial jobless claims, and let's have a look quickly at how it's performing. So yeah, we are persisting within this area of 200s, low 200s. Another very important element is this S&P global services out of the different areas. That's why it should be watched very carefully. So what we can say about that? Yeah, the PMIs is one of the most important indicator of where the economy is eventually heading. So PMIs are within a kind of a important element to watch. In terms of Bank of Japan, that is about to make a decision about its further policy, we can find that recently Japan's 10-year government note has surged, and despite this, Bank of Japan Kuroda not planning to shift their policy anytime soon. That's why we may find that these problems of weakening Japanese yen may still persist. And at the end, we have trade idea section, and that will be very interesting, I do find. That is gold. Gold right now, due to this trajectory, as one of this commodity that is on the verge of a strong upward trend, but it's about to collapse it. Right now, we can find that this 1671 area may get eventually breached. Let's now have a look at the chart in the shorter time horizon. We can find it in terms of gold. We are right now in a very important, in a daily chart territory, where we can find that this is the area of a possible support that recently been broken. So with this one tested about 5 times, it's a normal case that it will eventually break down. If we just have a look at shorter time horizon, we can find that gold is trying to attack those recent resistances at around low 1700s and 1690s. It may get stopped just with this recent point of resistance at 1687, and if we just manage to get over this one, that will be a perfect spot to make a bet to the downside. So if I just make a projection, if I just set my projection, there's another one, there's the last one stop being observed, that we may stop around here, but the more important one is at 1641, and with this one I do observe that the price supposed to stop for longer. So with this one, risk reward ratio would be at 4.9, and I do also like to push forward my point of view due to this bar chart commitment of traders, where we can find that large whales are right now selling off their positions. So with this one, even with commercials are eventually starting to minimize their hedges, right now we can find that these large whales are right now selling off their positions instead of buying that were back during the first quarter of 2022 before this major spike. So it's one of the point why we find that this is supposed to eventually happen. However, this recent price action is supposed to bring us back to this recent resistance. However, in the medium or longer time horizon, I do find the gold would rather suffer rather than have its prosperity ahead. So, and that's it in today's episode. Thank you very much for watching. If you have any questions, just put it in the comment section below the video, and see you tomorrow, 8:45, with the most updated, the most important news on the market.